You know, there's this really fundamental cognitive dissonance in how you and I just interact with the physical world every single day.
Oh, absolutely.
Like when you walk into your kitchen and turn on the faucet, you expect perfection.
No,
right?
You don't even think about it.
Exactly. You expect this flawlessly clear, pressurized, heavily treated water to just instantly flow from the tap.
Right. And because that expectation is met, like 99.9% of the time, we basically treat water like it's magic.
It's totally binary to us. The tap is either on or it's off.
Yep.
And it is completely decoupled in our minds from the staggering industrial violence required to pull it from a river, chemically alter it, and push it through this century-old labyrinth of underground pipes directly into a glass on your counter.
Right. We just demand that this daily utility remains entirely invisible.
We really do.
And that invisible utility, it's a luxury of the modern era, but it breeds this kind of dangerous financial ignorance.
How so?
Well, because we only see the water, we assume we're only paying for the liquid.
Right.
We forget that the liquid is basically free. What we're actually financing is the heavy machinery, the chemical engineering, and this massive deployment of human capital required to, conquer gravity and geography.
And when you start looking at the actual business behind that conquest, the illusion of simplicity just totally shatters.
Oh, it falls apart completely.
So today we are doing a deep dive into the Q2 2026 earnings call transcript from American Water Works.
Ticker symbol AWK.
That's the one. And our mission today, the reason we are putting this specific document under the microscope is because it represents the perfect microcosm of America's infrastructure crisis colliding head-on with Wall Street's demand for just endless compounding growth.
It really is a phenomenal source text for understanding the anatomy of a regulated monopoly.
Yeah, it's fabulous.
You've got management trying to satisfy institutional investors who want these aggressive, predictable yields, right?
Right.
While simultaneously negotiating with state utility commissions. And their entire political mandate is to keep consumer bills as low as humanly possible.
Caught between a rock and a hard place.
Exactly. And caught in the middle of that crossfire is an infrastructure grid that is actively decaying beneath our feet.
So we are going to track exactly how they navigate that crossfire. We'll look at the surgical precision required to keep operational costs completely flat in an inflationary environment.
Which is wild.
It is. But it's the only way they honor their pledge to keep your water bill below 1% of the median household income.
A really important metric.
Yeah. And we'll dissect their aggressive acquisition strategy, too. Mm-hmm. Snapping up dilapidated municipal systems and basically weaponizing their balance sheet to turn those broken pipes into guaranteed returns.
The dark arts of utility rate cases.
Exactly. We're going to translate all of that, including this highly aggressive legislative strategy they're testing in Missouri right now.
Oh, the future test year stuff.
Yeah, we'll get into that. Plus, we'll explore the looming shadow of their mega merger with essential utilities. And finally, pull apart the actual financial plumbing.
Pun intended.
Maybe. But, the debt issuances and equity forwards that actually provide the cash to keep this massive flywheel spinning.
The thread tying all of those elements together really is scale.
Scale, right.
Yeah, the utility space, scale isn't just about market dominance. It is, but it's also a defensive mechanism.
Against what?
Against inflation, against regulatory lag, and just the sheer cost of environmental compliance.
Well, let's test that theory by looking at their core operational scoreboard for the second quarter of 2026.
We'll do it.
Because the headline numbers tell a story of just almost surgical execution.
They really do.
They posted an adjusted EPS earnings per share of $1.61 for Q2.
Okay.
And if we map that against Q2 of 2025, where they sat at $1.49, we are looking at an 8% growth rate.
Right.
And zooming out to the first half of the year, they hit $2.62 up from $2.51. That 8% number isn't just a happy accident, is it?
No, not at all. It seems to be the foundational operating metric of the entire company.
8% is like the golden ratio for a regulated utility of this size.
Mm-hmm. Yeah, because think about it. If they were growing at, say, 15%.
Regulators would freak out.
Exactly. State regulators would immediately accuse them of over-earning and claw back their rates to protect consumers.
But if they drop too low.
Right. If they were growing at only 3%, Wall Street would dump the stock for underperforming basic treasury yields.
So it's a tightrope?
A very narrow tightrope. Hitting that 8% EPS growth year over year demonstrates to the market that their internal machinery for deploying capital and recovering those costs through rate cases is just perfectly calibrated.
And management knows exactly how much Wall Street craves that predictability.
Oh, they feed on it.
Right. They use this call to fiercely defend their full-year guidance of $6.02 to $6.12 EPS.
Which locks in that 8% target for 2026.
Yep. And they even reiterated their long-term growth corridor of 7% to 9% all the way through 2030.
That is a massive statement.
It is. When a CEO projects earnings 4 years into the future with that level of confidence, they're essentially telling the market that their construction pipeline and their regulatory approvals are already baked into the cake.
But that level of forward visibility, it requires a staggering amount of logistical choreography.
Right.
Like, they aren't guessing what the market will do in 2029.
No.
They have a localized, street-by-street ledger of exactly which treatment plants will require upgrades, which miles of pipe will reach the end of their usable life, and precisely when they will file the paperwork to ask regulators to pay for it.
It's all mapped out. But driving that top-line revenue through authorized rate hikes, it creates this automatic gravity on the expense side.
Inevitably.
The transcript outlines this inevitable drag, right? Like as soon as they build a new facility and put it into service, depreciation expenses immediately hit the income statement.
Boom. Right away.
Property taxes on the newly upgraded assets increase. And because they finance a massive portion of this through the debt markets, their interest expenses inherently rise.
Yeah, those are the unavoidable structural costs of being a capital-intensive business. You can't escape them.
Right. So the only way to counteract that structural gravity is through ruthless operational efficiency.
Because you cannot stop depreciation.
No.
And you certainly cannot negotiate with property tax assessors.
Good luck with that.
Right. So the only lever management actually controls on a day-to-day basis is their operations and maintenance expense, their O&M.
Which brings us to what I consider the absolute defining metric of this entire earnings call.
The flat O&M.
Yes.
Great.
Amidst rising depreciation, rising taxes, and the broader macroeconomic inflation we've seen on raw materials management, reported that their O&M costs were completely flat period over period.
Just flat.
Flat. I really want to linger on this because it just defies basic economic physics.
That does sound impossible.
Right. Keeping O&M flat while actively expanding your footprint and serving more customers, it's like managing to keep your family's weekly grocery budget exactly the same while adopting 2 teenage boys.
That is a great analogy.
Thank you. I mean, you can't just wish the food to be cheaper. You have to fundamentally re-engineer how the kitchen operates.
To run with that grocery analogy, you don't just change the menu, right?
No.
You bypass the grocery store entirely. You can negotiate direct contracts with the agricultural suppliers. You implement software to ensure not a single calorie is wasted. And you automate the cooking process.
Wow. Okay. Taking it to the extreme.
But that's what it is. In the context of American Water, achieving flat O&M requires aggressively deploying technology to remove human labor from routine processes.
We're talking about SCADA systems, right?
Yeah.
Supervisory control and data acquisition.
Precisely. They are installing remote sensors across thousands of miles of pipe to detect microscopic pressure drops.
Which allows them to pinpoint a leak and fix it before it becomes a catastrophic, expensive main break.
Exactly. They are moving from preventative maintenance, where you send a crew out to inspect a pump every 6 months, regardless of its condition.
Just because it's on the schedule.
Right. They're moving from that to predictive maintenance.
Where the machines talk to you?
Yeah, where machine learning algorithms tell you the pump will fail in 3 weeks based on its vibration frequency, so you only roll the truck exactly when necessary.
That is wild. And then you layer their procurement power on top of that technology.
Oh, the economies of scale.
Right. When you operate across multiple states, you aren't buying water treatment chemicals by the barrel. You are buying them by the trainload.
Right.
They can hedge their chemical and energy costs years in advance, creating this massive pricing moat that smaller municipal systems simply cannot replicate.
And that pricing moat is the absolute lifeblood of their affordability mandate.
The 1% pledge.
Yeah, you mentioned the 1% pledge earlier. And it is vital to understand how heavily management leans on this concept during the call.
It came up a lot.
It did. They have this self-imposed mandate to keep the average monthly residential water bill at or below 1% of the median household income in their service territories.
Which is a fascinating metric if you think about it. It's not a fixed dollar amount.
No, it's dynamic.
It's a floating peg tied to the macroeconomic health of the specific communities they serve. So if median wages in a town stagnate, American Water's ceiling for raising rates in that town effectively stagnates with it.
Regardless of what their infrastructure costs are actually doing.
Exactly.
It creates a brutal internal tension.
I can imagine.
Wall Street demands the 8% EPS growth, which requires deploying billions in capital, which requires raising rates.
But the 1% affordability pledge creates a hard ceiling on those rate hikes.
Right. And the only way to survive the pressure between that floor and that ceiling is by crushing operational costs.
The O&M.
Yes. The moment their O&M expenses spiral out of control, they either miss their earnings target, which tanks the stock,
Well, Wall Street would hate that.
or they break the 1% pledge, which invites the wrath of politicians and consumer advocates.
It is a total high wire act, and the flat O&M is the balance pole keeping them from plummeting.
Exactly.
But because they have that expense side locked down so tightly, they generate the excess free cash flow required to go on the offensive.
And they are very offensive right now.
Yeah, their offensive strategy relies on absorbing the very municipal systems that are failing to manage the inflationary pressures we just discussed.
The ones who don't have the trainloads of chemicals.
Right. And this growth engine is operating at a jaw-dropping scale. Just in the first half of 2026, the transcript shows they deployed $1.8 billion into capital projects and acquisitions.
Let's contextualize that number for you listening. Deploying $1.8 billion in 6 months means they're pushing roughly $10 million a day, every single day, into the ground.
$10 million a day.
That isn't just routine maintenance. That is a systemic overhaul of the grid.
And a significant chunk of that capital is dedicated to swallowing up smaller operators.
The acquisitions.
Yeah, the marquee announcement on this call was the closure of the Nexus Water Group acquisition, which actually finalized ahead of schedule on June 1st.
Nice early win.
Yeah, they absorbed 47,000 new customer connections and 70 local employees.
You know, the inclusion of those 70 employees is a really strategic detail.
Why is that?
Well, when American Water enters a new municipality, they face an inherent political hurdle. They're often viewed as this massive, faceless corporate entity taking over a vital local resource.
The big bad corporation coming to town.
Right. So by immediately absorbing and highlighting the retention of the local workforce, they signal to the state regulators and the local mayors that they are preserving community jobs.
Ah, smart.
While simultaneously bringing Wall Street capital to bear on the town's problems.
PR win. And Nexus is really just the tip of the spear. The pipeline they have under agreement is massive. As of June 30th, they are waiting to close on another 57,000 customer connections spread across 6 different states.
Which represents, what, $236 million in acquisition capital?
Yep, $236 million. Management explicitly stated they are targeting a baseline of 2% customer growth annually, purely through these municipal acquisitions.
Which is consistent.
But, you know, reading through the executive's commentary on the broader water sector, they constantly use phrases like fragmented industry and historically underinvested.
Yeah, I noticed that too.
They really frame themselves as the solutions provider rescuing these failing municipal systems.
It's a brilliant narrative framing. They position the acquisition not as a corporate takeover, but as a public sector rescue mission.
I want to challenge the underlying economics of that rescue mission, though.
Okay, let's hear it.
If a small municipal system is heavily underinvested, meaning, you know, the pipes are corroding, the pumps are failing, and the treatment facility isn't up to modern EPA standards, they are essentially buying a money pit.
They are buying broken assets.
Right. So why does Wall Street reward a utility for spending hundreds of millions of dollars to acquire severely dilapidated infrastructure? In any other industry, buying a broken factory would crush your margins.
It really would. But in the inverted logic of regulated monopolies, a broken system is the ultimate prize.
The ultimate prize.
It all comes back to the concept of the rate base.
Okay, explain that for us.
A utility's rate base is the total value of the physical assets they own that regulators allow them to earn a profit on.
So the stuff they've built.
Exactly. If American Water buys a pristine, perfectly functioning municipal system, there is no immediate need to deploy capital. They just collect the existing water bills, which offers very little EPS growth.
But if they buy a system that is falling apart?
If they buy a system that is falling apart, they have immediate justification to deploy massive amounts of capital. They rip out the failing cast iron, they build a state-of-the-art filtration plant, and they upgrade the meters. All of those capital expenditures are added to their rate base.
And the rate base is where they make their money.
Right. Regulators guarantee them an ROE, a return on equity, on every dollar in that rate base. So by acquiring dilapidated systems, they aren't buying a money pit. They are buying the legal permission slip to invest capital at a guaranteed 9% or 10% return.
That is, wow. It fundamentally rewires how you think about their business model.
It really does.
They aren't in the business of selling water. They are in the business of efficiently deploying capital. The water is just the delivery mechanism for the return on equity.
That is the defining characteristic of the entire industry. The product is the infrastructure, not the liquid.
But, that entire model hinges completely on the state regulators actually granting that permission slip.
Yeah, it's not a blank check.
Right. You can build the most beautiful, technologically advanced treatment plant in the world, but if the Utility Commission refuses to let you raise consumer rates to pay for it, your shareholders eat the loss.
And Wall Street does not like eating losses.
No, they don't. Which takes us right into the labyrinth of the regulatory dance. According to the transcript, American Water has been incredibly aggressive on this front.
Very busy.
Yeah, they wrapped up 3 major rate cases in West Virginia, Maryland, and Pennsylvania just in the first half of 2026.
And the management team made sure to highlight a really critical metric regarding those 3 cases on the call.
Yeah.
They were authorized to recover nearly 100% of their capital investments.
That 100% recovery rate is a massive flex.
Yeah.
It proves to the analysts listening that American Water's engineering and legal teams are just airtight. They didn't build a single mile of pipe that the regulators deemed imprudent or unnecessary.
Not $1 wasted.
But looking closely at the Pennsylvania case, the raw numbers reveal the intense political theater involved in these negotiations.
Oh, the theater's the best part.
It is. So American Water originally filed case asking for a $160 million annualized increase in revenues.
Okay.
When the dust settled and the final order was issued, they were approved for a $75 million increase.
That's quite a haircut.
They asked for $160 million, and they walked away with less than half. Yet on the call, management enthusiastically framed this as a constructive outcome.
I know. It seems totally contradictory until you understand the psychology of a general rate case.
Right.
A rate case is an adversarial legal proceeding.
It's a fight.
Yeah. The utility comes in with their initial filing, which is always an aggressively optimistic interpretation of their costs, their risks, and their required profit margins.
That's right.
That $160 million figure was likely based on the absolute highest cost of equity they could justify with a straight face.
Right. It's the equivalent of listing your house for 30% over market value.
Perfect analogy.
You know you aren't going to get it, but you need to anchor the negotiation as high as possible so that when the buyer forces you down, you still land on your target number.
Exactly the same dynamic. Yeah. Once that $160 million target is filed, the state's consumer advocates, the Utility Commission staff, and various industrial interveners immediately attack the math.
They tear it apart.
Right. They argue that the utility's debt is cheaper than they claim. They argue that certain executive compensations shouldn't be funded by ratepayers, and they demand a lower profit margin.
So the $75 million final number
is simply the mechanical result of that padding being stripped away through litigation and settlement.
So the top line revenue number is mostly theater then?
Mostly, yeah. The
number that actually dictates the financial health of the company is the authorized return on equity. And in this Pennsylvania case, the final order granted a 9.55% ROE.
And that 9.55% is the bedrock of their valuation.
Right.
In a macroeconomic environment where cost of capital fluctuates wildly, locking in a legally binding 9.55% profit margin on billions of dollars of infrastructure. I mean, that guarantees the dividend and funds the next round of growth.
That's why they call it constructive.
Exactly. Management calls it constructive because a 9.55% ROE allows them to easily attract new capital from Wall Street.
Okay, but the Pennsylvania case relied on historical rate making.
Yes. The old way.
Right. You build the infrastructure, you put it into service, you file a massive stack of receipts with the state, and then you beg for a rate increase to cover the money you already spent.
Right.
But the transcript points to a completely different, highly aggressive strategy they are testing in Missouri right now.
The future test here.
Yes. They are currently seeking a $179 million increase in Missouri based on $6 billion in system investments. But the twist is that these investments are slated for June 2025 through May 2028. This is the very first case filed using newly passed, fully forecasted future test year legislation.
This represents a tectonic shift in utility regulation. It fundamentally alters the temporal relationship between when a consumer pays and when a utility builds.
Let's break down why this is so radical. Using a future test year is conceptually bizarre.
It is.
It's like walking into your boss's office today and demanding a massive raise based entirely on the groundbreaking hypothetical work you promise to deliver over the next 3 years.
Right. Just trust me.
Yeah. Why would any state regulator agree to set consumer rates based on a corporate forecast of future spending rather than hard historical facts?
To understand why regulators are adopting this, you really have to look at the collateral damage caused by the old historical system.
Okay.
Historical rate making creates a massive problem called regulatory lag.
Regulatory lag being the painful financial gap between writing the check for a new water main and actually seeing the revenue to cover it.
Exactly. So consider a utility building a new $500 million filtration plant. Under historical rules, construction might take, say, 3 years.
Sure.
During those 3 years, the utility is borrowing money to pay the contractors, and they are paying interest on that debt. But because the plant isn't finished and serving customers yet, they cannot charge ratepayers a single dime for it.
Ouch.
Their balance sheet just absorbs the full weight of that debt.
So they are essentially starved of cash flow for 3 years.
Right. And to survive that starvation, they have to borrow even more money just to cover their operating expenses, which increases their overall cost of capital.
This sounds like a downward spiral.
It gets worse. Eventually, the plant is finished, they file their rate case, and it takes another 12 months of legal wrangling to get the new rates approved.
Right, the theater we talked about.
Right. And when those new rates finally hit, the consumer experiences massive rate shock.
The huge spike.
Yeah, sudden 15% or 20% spike in their monthly bill to instantly catch up on 4 years of deferred costs.
So historical rate making punishes the utility with cash flow starvation and punishes the consumer with massive, unpredictable bill spikes.
Nobody wins.
And the future test year is designed to smooth out both sides of that equation then.
Exactly. By using a fully forecasted model, the utility submits a highly scrutinized, legally binding engineering plan for the next 3 years. The regulators audit the blueprints and the financial models. If approved, the consumer rates are adjusted incrementally in real time as the capital is deployed.
It converts a massive delayed shock into a smooth, predictable glide path.
Right.
You know, during the Q&A segment of the call, an analyst tried to pin management down on the math here. They asked what the rate increase would have been in Missouri under the old historical rules compared to this new $179 million forecasted request.
And management totally dodged the direct comparison.
They did.
They claimed it wasn't an apples-to-apples scenario because the old rules might have forced them to delay or cancel certain projects due to cash flow constraints. Very. But they forcefully emphasized that the future test year significantly lowers their borrowing costs by providing immediate cash flow, which mathematically lowers the ultimate cost burden on the consumer.
It just requires an immense amount of trust from the regulators that the utility will actually execute the forecast accurately.
A lot of trust.
And managing these different regulatory frameworks state by state requires a massive logistical effort. They mentioned active rate cases in 6 different jurisdictions simultaneously.
It's dizzying.
They have a black box settlement being negotiated in Virginia, a partial settlement mapped out with the Public Advocate's Office in California, confidential dockets in New Jersey, and evidentiary hearings kicking off in Illinois with orders expected by October.
It is a perpetual motion machine of litigation.
That's a great way to put it.
They have entire divisions of engineers whose sole job is to translate physical pipeline data into legal testimony, and armies of lawyers fighting state by state to secure that 9.5% ROE.
Which makes their next strategic move so fascinating.
The merger.
Yes. While they are fighting street to street in these state rate cases, they are simultaneously trying to execute an industry-altering mega merger with essential utilities.
This is huge.
Absorbing small municipal systems like Nexus is routine for them, but essential utilities is a massive publicly traded whale.
If this merger clears, it fundamentally rewires the American utility landscape.
Completely.
The combined entity would possess unprecedented scale and lobbying power.
And the timeline management laid out is incredibly cautious. They announced the merger last October, and on this call, they reiterated that they do not expect to close until the end of the first quarter of 2027.
That is a long runway.
We are talking about an 18-month runway just to clear regulatory hurdles. So far, they have secured state approvals in Kentucky, Ohio, and Virginia, and they announced a settlement in principle in Texas.
Securing approval seat by state for a mega merger is like exponentially more difficult than a rate case.
Oh, yeah.
Every individual utility commission has veto power. If one major state decides the merger is harmful to their local residents, the entire multi-billion-dollar deal can collapse.
And the analysts on the call were hyper-focused on the vulnerability of that timeline.
They were nervous.
Very. There was a very tense moment during the Q&A regarding the political climate in Pennsylvania. An analyst specifically referenced the governor of Pennsylvania, who recently made headlines by aggressively intervening in a natural gas utility rate case, demanding lower rates for consumers.
That made some waves.
It did. The analyst was essentially asking management, with the governor taking a hostile stance on utility profits, is your merger going to get blocked in Pennsylvania?
It is the single biggest risk factor for the deal.
Right. Now, as a reminder to you listening, we're not taking a stance on the governor's actions here. We're just looking at how Wall Street perceived it as a risk.
Right, because utility commissioners are appointed officials. They do not operate in a vacuum. When a governor publicly crusades against utility costs, the commissioners face immense pressure to scrutinize every single corporate action through the lens of affordability.
I was struck by how surgically management handled that question, though.
Oh, they were pros.
They refused to acknowledge the political noise. They didn't mention the governor. They didn't complain about the environment. Instead, they anchored their entire response to the statutory legal standard in Pennsylvania,
which requires them to prove a substantial affirmative public benefit.
That phrase is a high legal bar.
Very high.
They cannot merely argue that merging with essential utilities will result in no harm to the consumer. They must proactively prove with empirical data that the merger will tangibly improve the lives of Pennsylvania ratepayers.
And management argued that their testimony clearly demonstrates that benefit, specifically emphasizing that the scale of the combined company will ultimately protect affordability.
Scale saves money.
Right. But this sparked perhaps the most revealing exchange of the entire call.
Oh, I know what you're going to say.
Another analyst followed up with a very logical question that gets right to the heart of the consumer mindset. The analyst basically said, okay, if you merge into this colossal entity and achieve all these massive economies of scale, does that mean you can slow down the rate cases? Can ratepayers expect a break from the constant price hikes?
It's the natural conclusion to draw. If merging saves money, the consumer should see that savings reflected in fewer rate cases.
But management threw cold water on that assumption immediately.
Just immediately shut it down.
They delivered a remarkably blunt reality check regarding the limits of financial engineering.
What did they say?
They pointed out the physical constraints of the business. Yes, a merger creates corporate synergies. You eliminate redundant software systems. You consolidate the C-suite. You merge the human resources departments.
All the back office stuff.
Right. That saves money on the O&M side. But the merger does not alter the physical reality of the infrastructure.
A corporate merger doesn't stop a 90-year-old water main in Pittsburgh from corroding.
Exactly.
It doesn't magically filter agricultural runoff out of the rivers.
Precisely. Management was unequivocal. Both American Water and essential utilities independently require billions of dollars in capital investments to maintain basic service. Combining the companies does not reduce the number of pipes that need replacing.
The capital requirements remain identical.
Right. Therefore, the necessity to file rate cases to recover that capital will continue on the exact same relentless schedule, regardless of the synergies achieved at the corporate headquarters.
It is a brutal reminder that you cannot spreadsheet your way out of infrastructure decay.
Nope. The work in the trenches must be done.
And it must be paid for. Which perfectly transitions us into the final piece of the puzzle, the actual financial mechanics holding this entire operation together.
Let's talk money.
We know they made billions of dollars, we know they're fighting rate cases in 6 states, and we know they're trying to merge with a giant competitor. But how do they actually manage the cash flow in the trenches between those massive multi-year regulatory battles?
This is where we get into the specialized regulatory riders that utilities use to survive.
The fast tracks.
Yeah. The analysts on the call spent a massive amount of time interrogating management on a specific mechanism called the DSEC.
DSEC, which stands for Distribution System Improvement Charge.
Right.
I look at the DSEC mechanism as a sort of regulatory toll lane.
I like that.
If a general rate case is a massive multi-year traffic jam where you have to prove every single expense across your entire corporate structure, the DSEC rider is the express lane.
Zoom right past the traffic.
Exactly. It allows the utility to take very specific predefined infrastructure projects, like ripping out and replacing aging underground mains, and pass the cost of those specific projects directly to the consumer through a fast-track surcharge on their bill.
Completely bypassing the massive rate case litigation.
Completely.
The DSCC is vital for mitigating that regulatory lag we discussed earlier. It provides rapid cash flow recovery for the most routine, predictable capital expenditures.
Which is huge for them.
And frankly, consumers prefer it. Instead of getting hit with a massive 15% rate shock every 3 years, the DSCC allows for micro adjustments, a 1% or 2% surcharge added to the bill incrementally as specific neighborhood pipes are replaced.
It makes sense. But here is the massive red flag that emerged during the Q&A.
Oh yeah, this was a big deal.
Management admitted that in key states like Pennsylvania, only about 40% of their capital spending actually qualifies to use this fast-track DSCC toll lane.
So the other 60% is stuck in the multi-year traffic jam.
Exactly. And that 40% figure reveals a massive historical bias in how state legislatures view different utilities.
Yeah, management pointed out that if you look at the electric utility sector in those same states, roughly 90% of their capital investments qualify for similar fast-track riders.
Why does an electric company get to fast-track 90% of their upgrades while a water company is capped at 40%? It seems crazy.
It comes down to the visibility of failure. Think about it. When an electric grid is underinvested, the failure is immediate, catastrophic, and highly visible. Power lines snap, transformers explode, businesses shut down, and voters get angry instantly.
The lights go out.
Right. Consequently, legislators gave electric utilities incredibly broad authority to quickly recover costs to harden the grid.
Keep the voters happy.
But water infrastructure is buried under the asphalt. It decays silently. A microscopic leak doesn't cause a blackout. It just slowly erodes the soil over a decade.
Out of sight, out of mind.
Exactly. Because the failure is invisible, legislators never felt the political urgency to grant water utilities the same broad recovery mechanisms.
But that invisible decay is rapidly becoming visible. And management made it clear they are lobbying heavily to rewrite the rules.
They have to.
They specifically mentioned pushing legislatures to expand the definition of DSCC-eligible projects to include critical assets like storage tanks and, most importantly, PFAS treatment facilities.
PFAS, the forever chemicals.
Yes.
This is the existential capital threat looming over the entire water industry right now. The federal government is implementing strict new limits on these microscopic compounds, which means water utilities are going to be forced to build incredibly complex, wildly expensive, advanced filtration systems to remove them.
And if American Water has to spend hundreds of millions of dollars building PFAS filtration plants, and those costs are trapped in the 60% bucket, that doesn't qualify for the fast-track DSCC lane.
Their cash flow is going to be severely compressed.
Right. They will be forced to absorb massive amounts of debt while waiting years for the general rate cases to reimburse them.
Which hurts the ROE.
Expanding that DSCC lane to include environmental compliance like PFAS isn't just a regulatory wish for them. It is a mathematical imperative for their balance sheet.
Which brings us to how they are actually funding the upfront capital before the regulators reimburse them.
The actual cash.
Right. They detailed two major financing maneuvers on this call that showcase their elite access to capital markets. First, they reported their total debt-to-capital ratio sitting at 58% as of June 30th.
You know, to a normal corporation, carrying 58% debt looks highly leveraged.
It sounds scary.
But for a regulated utility with guaranteed ROEs, that is a perfectly optimized balance sheet.
Yes, it is.
And they proved their access to debt on May 20th, when they successfully issued $500 million in long-term bonds at an interest rate of 4.625%.
Securing $500 million at 4.625% in the volatile economic environment of mid-2026 is a massive endorsement from the bond market.
They love it.
Institutional investors view American Water's debt as a safe haven. It yields slightly more than a treasury bond, and the payments are implicitly backed by the Utility Commission's mandate to keep the company solvent.
But they can't fund everything with debt, right? Otherwise, their credit rating drops.
Right, they have to issue equity too.
And the transcript details a deeply complex equity strategy that is definitely worth unpacking. In June, they raised $476 million by settling 3.4 million shares of what they call equity forwards.
Okay, this part is brilliant.
They noted they have a total of roughly 8 million shares locked in these forward agreements, and they plan to settle the remaining shares in the fourth quarter.
The equity forward is just a brilliant piece of financial engineering utilized by companies with massive multi-year construction pipelines.
Let's break down how it actually works for you listening. If a normal company needs $1 billion, they issue $1 billion worth of stock today, right?
Right.
The cash hits their bank account immediately, but they also instantly dilute their existing shareholders. And they immediately have to start paying dividends on those millions of new shares.
Yes.
But if American Water is building a $1 billion pipeline over 2 years, they don't actually need the $1 billion today.
They don't.
They need it in monthly installments to pay the welding contractors.
Because if they take all the cash on day one, it just sits in a low-yield checking account while they pay high-yield dividends on the newly issued stock.
It's wildly inefficient.
It is.
So the equity forward solves that inefficiency. They go to an investment bank and lock in a guaranteed price for their stock based on today's valuation.
Okay.
They sign a contract stating they have the right to sell 8 million shares to the bank at that locked-in price at any point over the next year.
It removes the market volatility risk completely. They know exactly how much capital they have access to, regardless of whether the broader stock market crashes tomorrow.
And then they only settle or draw down those shares in precise tranches, like the 3.4 million shares in June, at the exact moment the construction invoices come due.
Just-in-time financing.
They match their equity dilution perfectly to their capital deployment schedule. It is financial logistics operating at the absolute highest level.
You step back and look at the entire machine they have built. Locking in equity prices with forward contracts, securing cheap long-term debt, deploying $1.8 billion into the ground, acquiring 47,000 new customers to expand their rate base.
Lobbying for future test years to eliminate regulatory lag.
And crushing operational expenses to hit an 8% EPS growth target. It is a masterful, grinding execution of a profoundly complex business model.
It really is. And that realization fundamentally alters how you should view your monthly water bill.
It's not just a water bill.
No. The next time you open that envelope or look at the auto draft on your bank statement, you need to recognize that you are not simply paying a volumetric charge for hydrogen and oxygen.
You are paying a subscription fee to an incredibly vast, capital-intensive logistical ecosystem.
Exactly. Your monthly payment covers the interest on those $500 million bonds. It pays the lawyers arguing for a 9.55% ROE in a Pennsylvania hearing room. It funds the salaries of the 70 newly acquired Nexus employees, and it pays for the diesel fuel in the excavator, digging up a 100-year-old cast iron pipe beneath a street you've never even heard of.
You are participating in a shared financial responsibility for a public necessity managed by private capital.
It's a lot to think about.
It is. Which leaves us with a critical tension to consider moving forward.
What is the tension?
The entire social license for American Water to operate, their ability to appease regulators and expand their monopoly, rests entirely on that one pledge. Keeping the average residential bill below 1% of the median household income.
Right.
Is the political shield that protects their 8% EPS growth. But look at the sheer mathematical weight of the realities we just unpacked.
The future costs.
The impending mandatory capital requirements to build PFAS filtration facilities across the country. The relentless, unavoidable need to replace millions of miles of century-old pipe before it catastrophically fails.
And the structurally higher cost of debt required to finance all of it.
Yeah. Exactly. Even with flat O&M costs and the efficiencies of a mega merger, you have to ask, can that 1% affordability promise physically survive the next decade of infrastructure realities?
That is the $1 million question, or I guess the $1 billion question.
It feels as though we are watching a slow-motion collision course between the absolute necessity of public health investments and the breaking point of working-class affordability.
A mathematical collision course. It makes you realize that the magic isn't that the water flows when you turn the tap.
No.
The real magic is that the invisible $1 billion machine behind the drywall hasn't broken under its own financial weight yet.
That's the real magic.
Something to think about the next time you pour a glass of tap water.
Thank you for joining us on this deep dive.